Stop everything right now. What if the next 90 days decide whether your business finally breaks free from the cash flow nightmare or stays stuck forever? Most owners are just one bad month away from disaster because they overlook the core rules that successful business owners follow daily. In this video, you will learn all business finance rules to master business finance step by step. Mindset and core habits of financial mastery. What truly separates businesses that survive from those that thrive financially? Is it luck, industry, or something deeper? Let's begin by examining the habits and mindset that great entrepreneurs quietly practice every single day. The very first rule most successful business owners live by is pay yourself first. Before you pay suppliers, employees, taxes, or even marketing bills, set aside a fixed percentage, 10 to 20% of every dollar of revenue, for your personal savings, investments, or owner's draw. Why does this work so powerfully? Because it forces discipline and treats your personal wealth as a non-negotiable expense of the business. Next, ask yourself, are you truly living below your means both personally and in your company? The moment your lifestyle or business spending matches or exceeds incoming cash, growth becomes impossible. Living below your means creates a permanent buffer that funds opportunities instead of emergencies. Now consider cash is king, especially during uncertainty. Profit on paper means almost nothing if your bank account is empty when a supplier demands payment or a customer delays 90 days. Have you ever tracked how many days of operating expenses your current cash reserves actually cover? Most businesses collapse not because they're unprofitable, but because they run out of cash. That leads us to another timeless truth. Revenue is vanity. Profit is sanity. Cash is reality. You can celebrate $10 million in sales, but if your net profit is 2% and your receivables are stuck for months, the celebration is an illusion. True masters obsess over cash flow forecasting, not just income statements. Let's introduce the rule of 72 here as well. How long does it take for your money to double if invested at a certain return? Divide 72 by your annual rate of return. At 8%, money doubles in 9 years. At 12%, it doubles in 6 years. Understanding this rule changes how you view reinvestment decisions. Should you leave profits in the business earning 15% or pull some out and invest elsewhere at 10%? The rule of 72 gives you the mental shortcut to compare opportunity costs instantly. In this foundation stage, embrace "he who has the gold makes the rules." The more cash and capital you control, whether your own or OPM, other people's money used wisely, the more strategic choices become available. Debt can be a powerful accelerator, but only when used to buy assets that produce more cash than the interest costs. Ask yourself honestly, right now, are you the one holding the gold, or are you the one begging for it? These 4 interlocking habits, paying yourself first, living below means, obsessing over cash, and understanding capital control form the bedrock. Without them, even the most brilliant strategy eventually crumbles. Risk, diversification, and protecting what you build. What would happen to your business tomorrow if one major client, one key supplier, or one revenue stream suddenly disappeared? Let's explore why smart risk management is not about avoiding danger entirely, but about making sure no single blow can knock you out. The oldest and most powerful rule here is simple yet profound. Never invest money you cannot afford to lose. In business terms, this means never tying up so much capital, whether in inventory, equipment, marketing campaigns, or expansion, that the failure of that bet threatens the survival of the entire company. Ask yourself honestly, if this next big decision goes completely wrong, can the business still pay its bills next month? This naturally leads us to one of the most quoted yet under-practiced rules. Don't put all your eggs in one basket. Diversification is not just a stock market slogan, it's a survival strategy. Spread your revenue across multiple customers, so no single client represents more than 15 to 20% of total income. Diversify product lines or services, so you're not dependent on one offering. Spread suppliers, so a disruption in one region or vendor doesn't halt production. Spread investments of surplus cash across different asset classes, some in the business, some in liquid reserves, some in outside markets. Have you ever mapped out what percentage of your total economic engine relies on any one pillar? Most owners are shocked when they do this exercise for the first time. Now let's talk about protecting gains with two classic trader sayings that apply perfectly to business owners. Cut your losses and let your winners run. When a product, market, or project is clearly failing, burning cash, losing customers, or showing no traction, how quickly do you pull the plug? The longer you wait to admit a mistake, the more resources you pour into a sinking ship. Conversely, when something is working exceptionally well, do you starve it of reinvestment because you're playing it safe, or do you feed the winner more capital, more attention, more team members? The businesses that scale fastest are ruthless at letting go losers early and generous at scaling winners. Another protective gem, Murphy's Law in finance. Anything that can go wrong will go wrong. Expect delays in payments, unexpected repairs, sudden regulatory changes, or key employees leaving at the worst moment. The practical response is not pessimism, it's preparation. Maintain a cash buffer equal to at least 3 to 6 months of core operating expenses. Build redundancy into critical systems. Negotiate flexible contracts whenever possible. When you assume things will break, you build stronger defenses before they do. Finally, remember that true mastery comes from asking, which of my current risks am I actively managing right now, and which ones am I pretending don't exist? The moment you start treating risk as a deliberate design choice rather than an accident, your business becomes anti-fragile, stronger because of uncertainty rather than destroyed by it. Practical budgeting, withdrawal, and sustainable growth rules. How do you decide how much of your business profits can safely leave the company without starving future growth? Let's turn our attention to rules that help you balance today's rewards with tomorrow's opportunities. One of the most practical frameworks used by both entrepreneurs and financial planners is the 50-30-20 budget rule, adapted beautifully for business owners. Allocate 50% of after-tax net profit to necessities, like reinvesting in core operations, debt reduction, essential overhead. 30% to business wants, like marketing experiments, team bonuses, new equipment, research and development, and 20% to savings and owner distributions. Does your current profit allocation feel disciplined like this, or is it more reactive and emotional? When you force this split every month, you create automatic guardrails that prevent lifestyle creep or reckless expansion. Next, consider the 4% safe withdrawal rule, not just for personal retirement, but for determining how much you can sustainably pull from a mature business without eroding its capital base. The classic guideline says that if your business generates consistent real returns after inflation of around 6 to 7%, you can safely withdraw about 4% of the enterprise value each year and still expect the principal to last 30 years or more. For example, if your business is valued at $2 million and producing steady cash flow, a safe annual owner draw might hover around $80,000. Have you ever calculated what percentage of your current business valuation you're actually withdrawing? Many owners unknowingly pull 10 to 15% or more, speeding toward burnout or forced sale. Now let's connect this to pricing and positioning with the rule of 3. In competitive markets, customers tend to sort offerings into 3 mental buckets: good, better, best. Businesses that offer only one price point often lose sales to cheaper alternatives or premium competitors. By deliberately creating 3 tiers, entry-level for price-sensitive buyers, core for most customers, and premium for high-value clients, you capture more of the market and increase average revenue per customer. Ask yourself, does your current pricing strategy naturally fall into these three buckets, or are you stuck in a one-size-fits-all trap that leaves money on the table? Another pipeline-focused rule that drives predictable growth is the 10-3-1 rule for sales. Out of every 10 qualified leads you speak with, expect roughly 3 to show serious buying intent and only 1 to close. Knowing this ratio upfront changes how you build your funnel. If you want 10 new customers this quarter, you need to generate 100 qualified leads and nurture 30 opportunities, not just chase 10 random prospects and hope. The beauty of this rule is its brutal honesty. It forces you to scale the top of the funnel early rather than panic at the end. These budgeting and growth rules work together like a system. Disciplined allocation protects cash flow, safe withdrawal prevents over-extraction, tiered pricing lifts margins, and clear sales math turns hope into predictable revenue. Which of these feels most foreign to how you currently run your numbers, and which one could you test in the next 30 days to see immediate clarity? Leverage, OPM, and turning other people's money into your rocket fuel. What if the fastest way to grow your business wasn't grinding harder with your own cash, but intelligently using other people's money? Let's examine one of the most powerful yet dangerous rules in advanced business finance. OPM, other people's money, used wisely. Bank loans, supplier credit, customer prepayments, revenue-based financing, venture debt, private investors, all are forms of OPM. The masters don't avoid leverage. They treat it like nitroglycerin, incredibly explosive when handled with precision, catastrophic when sloppy. Ask yourself right now, what is your current return on invested capital? If your business consistently generates 25 to 40% ROIC on new projects, then borrowing at 7 to 12% is pure arbitrage, free growth fuel. But if your returns are only 8 to 10%, adding debt slowly suffocates you. The golden question becomes, are you using OPM to buy assets that produce more cash than the cost of capital? Or are you using it to plug operational holes and delay hard decisions? Great operators deploy leverage in 3 specific ways. First, for revenue-generating assets, equipment that immediately increases production capacity, marketing campaigns with proven positive ROI, inventory that turns fast at high margins. Second, for time arbitrage, locking in long-term supplier contracts or real estate at today's prices when inflation is rising. Third, for optionality, maintaining unused credit lines as dry powder for distressed opportunities when competitors are forced to sell. Now layer in the advanced version of he who has the gold makes the rules. The moment you need money desperately, terms become brutal, higher interest, personal guarantees, equity dilution at low valuations. But when you already have strong cash flow and multiple banking relationships, lenders compete to give you better rates, no personal guarantees, and flexible covenants. This is why building fortress-like finances in good times gives you outrageous bargaining power in bad times. Combine OPM with the rule of 72 in reverse. If you can borrow $1 million at 8% and deploy it into projects returning 20%, you're creating a 12% spread. That spread causes the borrowed capital to effectively double every 6 years, while someone else pays the interest through tax-deductible business expenses. Over 10 years, that single disciplined leverage decision can turn $1 million of OPM into $4 to $5 million of equity value without you putting in another dime of personal capital. The difference between entrepreneurs who stay small forever and those who build 9- and 10-figure empires often comes down to one thing: their relationship with intelligent leverage. So here's the uncomfortable question. In the last 12 months, has every dollar of debt or outside capital you've taken on clearly increased your business's intrinsic value, or has some of it merely kept the lights on? Be brutally honest, because the masters don't lie to themselves. Execution discipline, cutting losses, following trends, and knowing when to fight. What separates businesses that adapt and compound wealth from those that slowly bleed out, even when they're right on paper? Let's turn to the execution rules that protect your capital and keep momentum on your side. Start with one of the hardest yet most liberating principles. Cut your losses and let your winners run. In practice, this means setting clear, predefined failing criteria before you launch any significant initiative, whether it's a new product, a marketing channel, a geographic expansion, or hiring for a key role. For example, if a new campaign hasn't achieved break-even within 90 days despite reasonable traffic, or if a product line is still losing money after 6 months of iteration, do you have the discipline to shut it down quickly? The longer you delay letting go a loser, the more cash, time, and emotional energy it drains. Conversely, when a channel, product, or customer segment is delivering outsized returns, say 3 times your average profit margin, do you hesitate to scale it aggressively because it might not last? Or do you feed it more budget, more team, more automation? Winners compound fastest when you recognize them early and act decisively. This ties directly into don't fight the tape. In trading, the tape is the live record of price and volume movement. In business, it's the real-time signal of cash flow, customer behavior, market demand, and competitive momentum. When invoices are paying faster, repeat purchase rates are climbing, referrals are surging, or industry tailwinds are obvious, fighting against that momentum is almost always a losing battle. The disciplined owner asks, what is the market actually telling me right now? Not what I wish it would say, but what the data is screaming. Aligning with the prevailing direction doesn't mean abandoning strategy. It means riding the wave intelligently until evidence shows the trend is truly exhausted. Now consider the brutal realism of bulls make money, bears make money, pigs get slaughtered. Greed is the silent failure of more businesses than fear ever was. During boom times, when customers are throwing money at you, credit is cheap, competitors are over-leveraged, and headlines scream, "This time it's different." The temptation to double down, borrow heavily, chase every shiny opportunity, or dramatically expand, headcount becomes overwhelming. The masters stay sober. They ask, "Am I becoming a pig?" They take chips off the table, build bigger cash reserves, lock in long-term contracts at peak valuations, and quietly prepare for the inevitable correction. The pig gets slaughtered not because it was wrong about the direction, but because it bet everything at the worst possible moment. Remember the protective warning. The market can stay irrational longer than you can stay solvent. You might see a competitor's pricing as unsustainable, a customer segment as overpaying, or a trend as doomed. But being right too early can destroy you if you've shorted your own cash flow or overinvested against the crowd. Patience and evidence, not ego, win. These 4 execution rules form your behavioral firewall. Avoid losers fast, scale winners boldly, ride trends instead of fighting them, and tame greed before it tames you. So tell me, honestly, not for me, but for you, if you made that promise today, what is the very first small, uncomfortable action you would take tomorrow morning? And what part of you is already resisting it, and why do you think that resistance has been winning until now? This is where the real journey begins. Not with more rules, with one decision.